friends, market participants, and enthusiasts right around the world. Thanks a lot for joining me on this Tuesday afternoon market recap. What we have seen today take place collectively across all three of the closely followed US indices has been that of a fairly decent down day. It was one of the largest down days that we have had in approximately 4 months. The Dow Jones Industrial Average, we closed down 364 points. Again, we have seen another gap in the bearish direction. This is after, of course, the inside day candlestick that we saw on Monday to begin this week's worth of trade. Now, what makes this interesting is that really since 1 week ago, where I put out the last public update, we were speaking about, of course, this back test that was set to take place roughly around this 26,300 area on the Dow Jones Industrial Average. This is essentially stemming from the back test of a decelerating fan line, which has kick-started, of course, the bull market in 2009. You can see on my screen here, I know it is a little bit hard to see. It is a little bit messy with a bunch of lines, a lot of horizontal lines on my screen, but if you pay attention, this upward line that I'm drawing on my screen, what we are essentially doing at the current juncture is actually back testing this decelerating fan line. Now again, when we start stretching these decelerating fan lines over such a long period of time, we have to allow a little bit of variance, or I guess degrees, in the amount of points, give or take, where that resistance area can actually show up. Now, we overshot that towards the end of last week. It had me sort of scratching my head a little bit, but I did speak about this in great detail over the weekend. And again, going back into the metrics of this market, and just to put into perspective just how overbought we are, really since we've been keeping track of financial markets, we haven't seen collectively the industrial average, the S&P 500, and the NASDAQ as overbought as what it is currently registering, or what it was registering towards the end of last week in its entire history. Again, on Trade Navigator, the software I use to trade on the Dow Jones Industrial Average, this goes back to the year 1900 itself. So, I mean, we are statistically looking at about 118 years of data, and not once have we been as overbought. Once again, just to stress how important this is, just how overbought we were towards the end of last week. And again, what we're seeing right now is potentially a little bit of a snapback, which is long overdue, and we have been expecting this. It did take a little bit longer, essentially, for this to show up, but as you can see, the week which is currently underway, Monday and Tuesday, it has been that of a relatively bearish week to begin. Now, if we go to the weekly candlestick, this is what we call a tweezer top, and again, it's showing right up at this resistance area. You can see this red line. This is the extension of that decelerating fan line, and again, it's respecting that resistance area as we have expected. Again, just to stress, we have just set up a tweezer top on the Dow Jones Industrial Average. This asks us now, or at least poses the question, what happens with the US financial markets? Well, in terms of the Dow Jones Industrial Average, when we get a gap, and a gap in the opposite direction without really any warning, generally this is that of a reversal gap. Now, I'm not going to go out on a limb and call this that of a reversal gap. Generally, what we will do, of course, is come back up and actually close the gap. So potentially this week, come Friday, you might see the Dow Jones Industrial Average trading back up pretty much to the close of where we were on Monday, but that's going to set up a pretty neutral sort of bidirectional trade. Come next week, if we can get the bounce, we can hold and close that open window. Then, of course, we'll look at this more neutrally moving forward. But at the moment, it's anyone's guess whether or not we're just going to blow through some of this upward support, as you can see on these exponential moving averages, or whether or not we're actually going to, again, bounce back up, close the gap, and then, of course, continue the bullish direction, which has been predominantly a very strong start to 2018. January has been that of a tremendously bullish month to begin the financial year. It is, of course, continuing on from a blockbuster 2017. But at the moment, we are starting to see, of course, a little bit of selling come into the financial markets. Now, again, if I can continue this discussion into the S&P 500, we do have a very similar type of scenario setting up. We do have that of an inside day candle on Monday. It isn't really that of a tweezer top. It isn't as long of a sort of a dark Mariposa candlestick that we'd like to see, but we still have this gap, which is very evident, very clearly pronounced between that of Monday and Tuesday. We'll have to pay attention to this. If you did have your stop placed at 2,873, you should be out of those SPY trades at this particular time. I'm happy about these dashed lines at the moment. You can more or less make them default at the moment. They can become, of course, conditional entries, because we have started to see this pullback back into these rising exponential moving averages. As you can see, the S&P 500 now sitting on that 10 exponential moving average. The Dow Jones Industrial Average has cracked the 10 exponential moving average. And if I continue into the NASDAQ itself, you can see that although we did have a gap in the bearish direction, we did essentially print out of a white candlestick. So you can see immediately, even on the gap down, we are starting to see once again buyers show back up into this market. Now, if I can quickly run through this with you, these are the oscillating indicators for the NASDAQ, which I'm showing you on my screen at the moment. If I go out to this monthly chart, this is what's most important. If I take these annotations off the screen, you can see on my screen right now that if you pay attention to the RSI, this is statistically going back to 1985, you can see on my screen. And it's really hard to actually see this. I mean, I really wouldn't be paying all that much attention to the actual closing line chart that I've just switched to. It's more so the relative strength index, because what we're doing at the moment on a monthly chart is we're printing at 92.01. And if I can bring up that of a horizontal line, I did this over the weekend, you can see on my screen, there's only been one occasion, and this is going back to 1996, where the NASDAQ has registered above this line. Now, this is sort of the outlier of the three markets. If I go into the Dow Jones Industrial Average and actually bring up a little bit more data, you can see it's going back all the way to 1926 at the moment. There is more additional data, but I really have to move this over for you to actually see it. You have to take my word for it. But as you can see, we're putting at 95.21. This is the highest that the relative strength index has been. And of course, this registers that of very short term, or at least on the monthly chart, overbought settings. So again, these markets again are pushing statistical norms that we haven't seen ever, really. And again, you have to pose, or at least the question becomes, are we starting to revert back to the long-term mean of these markets? I don't think it's going to happen over a number of weeks coming up. It is probably going to take more on the line of a real market sort of retracement or major correction. But again, a lot more technical analysis has to fall into place until we can champion that. We have to see, again, a series of lower highs and lower lows. We also have to see some major chart pattern reversals up and around these all-time highs on the markets collectively. And we're also going to have to see a few other pieces of analysis until we can really begin to change our long-term direction or understanding of where these markets are moving. At the moment, we have to assume that this is that of a minor, or at least an intermediate correction within that of a larger macro uptrend. But it is very important that you understand, again, some of these parameters that we are hitting, or what we have recently hit in terms of overboughtness, or in sense of being just simply overbought. Now, again, there's a little bit of mania out there. You can clearly see it in the price action with the actual sentiment and the psychology of active market participants trading these financial markets. When you look at technical analysis and you apply analysis to the financial markets, when you can be as objective as just simply looking at technical indicators. Again, if I change into the S&P 500, these settings really just tell it to you how you need to be told. It is very upfront and straightforward. But again, this is the S&P 500 on the monthly setting. The RSI itself printing just shy of 95. We haven't been this overbought on this setting in the history of really recordable statistics for the S&P 500. You can see on the monthly charts, we've got the Dow and the S&P hitting these absolute extremes. We've got the NASDAQ where pretty much we're at that very same spot, except for that one period of time in about 1996. And again, what we're seeing more so on the minor level at the moment, especially between that of Monday and Tuesday, is that natural sort of snap back to the downside. We're not calling this a major reversal. If anything, we're pulling back into these rising exponential moving averages. But again, the narrative really in the theme of, I guess, Pro, not only last week, but the week before that, was simply to recognize that. And then, of course, to enter the week with a little bit of caution, because we have been expecting that of a retracement, all right, a long overdue retracement. And that can set up in the form of a sort of a channel consolidation. It doesn't have to be that of a major sort of reset down to the 50, but we'll have to obviously work with it. I assume that over the week, and maybe even towards the entire week of action, we're simply going to come back up, close the gap, and we'll be looking at the week upcoming in a very neutral sort of outlook. But, you know, we'll pay attention. We'll see what happens on Wednesday. At the moment, though, I wouldn't be looking to jump back into this market immediately. We still have a long way to go until these oscillators can even reset on the daily time frame. Even after really Monday and Tuesday's days worth of selling, we haven't done anything really to adjust out of the stochastics or the MACD. The MACD, in fact, is only just crossing bearish. This is collectively across the board, the S&P 500. You can see for yourself. Pay attention to the MACD on my screen. The stochastics is still registering extreme overbought levels. The RSI is going to snap back. It is the fastest of the three oscillators. And again, the NASDAQ, just to really surmise this market at the moment, Stokes is still relatively overbought, extremely overbought, I should say. The RSI is adjusting. We've only just moved out of extremely overbought levels. And again, the MACD looking to cross down as well. Now, when it comes to our top 12 individual trade list, about half of these stocks have actually reported. We do have a busy week, really Wednesday through Friday. That's going to conclude our top 12 list. But it doesn't really look as though we're going to have much action at this particular point. The market pulling back. I think we're going to have some great opportunity once we see that sort of minor or intermediate bottom put into the market. That will sort of coincide with that next higher low, and then of course the bullish continuation to the upside. That is, of course, if things hold at the rising exponential moving averages. If we see price action hold at those rising exponential moving averages. If we do not see that, I'll be coming back on this public YouTube channel, and I will be speaking about that of a larger sort of correction. Of course, we'll have to confirm that through the technicals, but at this particular point, I wouldn't be worrying all that much. We've been expecting this. I'm quite happy that it's finally come. And again, the Dow Jones Industrial Average more or less is respecting this back test of this decelerating fan line, which has really began or pronounced itself at the beginning of the bull market in 2009. And really the last time we actually reset or actually came back up to retest this was in the year 2011. So it looks as though that resistance is holding. We'll see what happens on Wednesday, but I'm assuming we're going to see a market bounce. It may not be it may not be Wednesday. It may come on Thursday or Friday, but we should see these gaps close collectively. Then we'll come back and we'll start looking at these markets as neutrally as we can. And of course, paying attention to those oscillators, which simply need a little bit of time to actually reset at this particular juncture. All right. So on that note, everyone, enjoy your Tuesday evening. I'll be back with you most likely tomorrow on Wednesday. There is a lot at stake with the financial markets, a little bit of volatility, which is always nice from time to time. And until then, everybody, it's James signing off on behalf of Pivot Point Trading. Farewell.